Imagine this. You owe a lot of money, and the person you owe it to is China. You rely on them to keep lending you money to pay your bills, but suddenly they stop. Now your options are limited, and things are starting to look pretty uncertain. In today's video, we're diving into a huge question. What happens if China stops buying US debt? This isn't just an economic thought experiment. It could shake up the global financial system in significant ways. For years, China has been one of the largest buyers of US debt, holding over $1.3 trillion in US Treasury bonds in 2013. The US government has used these funds to finance its deficits, and this system has been crucial for global stability. But what if China decided to pull back? Which China already did. China has been steadily selling US Treasury bonds since the beginning of Donald Trump's trade war in 2018. And as of right now, China holds about $757 billion of US debt. And what if China continues to sell? What does this mean, and how will it impact the global economy? Let's break it down. Number 1. The dollar could lose value. When China stops buying US debt, one of the first things that could happen is the US dollar could drop in value. Now, why does this matter? China buying US debt has historically been one of the reasons the US dollar has remained strong. By buying these bonds, China is essentially helping the US government fund its activities while creating demand for the dollar on global markets. Let's think of it this way. Imagine a store that sells a product everyone needs. The store sells so much of this product that it becomes the go-to choice in the market. But when this store stops making its product available, other stores or countries are going to step up. They might not have the same product, but they'll try to find alternatives. This shift in supply and demand can cause the original product, the dollar, to lose some of its appeal. When China pulls back, the global demand for US dollars would likely decrease, and as a result, the value of the dollar could decline. The dollar losing value doesn't just affect finance professionals, it has real consequences for you and me. If the value of the dollar drops, inflation is likely to rise. This means goods and services, everything from groceries to electronics, could become more expensive. This happened in the 1970s when inflation was high and the US dollar was weaker due to international factors. For example, a weaker dollar would make things like oil or cars, which are priced in dollars globally, more expensive for Americans. So if China stops buying US debt, a weaker dollar means higher costs of living for US citizens. Number 2. Interest rates could rise. Borrowing gets more expensive. When China stops buying US debt, the US government might struggle to find other buyers for its bonds. Why does this matter? Let's say you want to buy a house. If fewer people are buying homes, you'd have to lower the price to get someone interested. Similarly, when there are fewer buyers for US bonds, the US government might have to offer higher interest rates to attract investors. For example, the US Treasury could offer higher yields to entice buyers. But when the government has to offer better returns on bonds, that means borrowing money becomes more expensive. This isn't just about the government. It affects everyone who needs to borrow money, including home buyers, business owners, and students. In practical terms, if interest rates go up, it would make mortgages more expensive, which could hurt the housing market. Let's say you're planning to buy a house. If interest rates rise from 3% to 5%, your monthly payment could increase significantly. A typical $300,000 mortgage would see a jump in monthly payments of over $400 just from a 2% rise in interest rates. So higher borrowing costs could lead to a slowdown in consumer spending, and businesses might hold off on expansion plans. To give you some historical perspective, we saw similar effects in the 1980s. During that period, the US raised interest rates to combat inflation, and it led to higher mortgage payments, car loan rates, and business financing costs. So, if China stops buying US debt, the consequences for interest rates could be dramatic. Number 3. The US government faces more budget problems. Now, let's zoom out a little and think about the US budget. The US government spends a lot on defense, healthcare, social security, and other programs. To fund all of this, the government borrows money by selling bonds. So when China buys US debt, it helps keep interest rates relatively low and the US can borrow cheaply. But if China stops buying US debt, the US government might have to pay higher interest rates, which would increase the budget deficit. In simple terms, a higher deficit means the government is borrowing more money to cover the cost of its programs. When borrowing becomes more expensive, the government might have to make difficult choices, like cutting spending on social programs or raising taxes. The US already has a large budget deficit, over $1.5 trillion in 2023 alone, and it relies on foreign buyers like China to keep borrowing costs low. Without China's help, the US government might have to cut spending or borrow even more, and this could hurt the economy and lead to higher taxes for US citizens. Number 4. China might diversify its investments, shifting focus to other currencies and assets. But China's decision to stop buying US debt isn't just a one-way street. It could have major effects on China itself, especially if it moves to diversify its investments. China could start investing more heavily in its own currency, the yuan, or it could stockpile gold as a hedge against global economic instability. In fact, China has been working to internationalize the yuan for years. By moving away from US debt, China could boost the global use of the yuan in trade and finance. Right now, the US dollar is the world's reserve currency, but China has long wanted the yuan to play a bigger role. If China shifts away from US debt, it might create a new financial world order where the yuan replaces the dollar in many international transactions. One potential outcome of this shift is that other countries might follow China's lead. Countries like Russia, Iran, and Brazil have already been exploring alternatives to the US dollar for trade. If China stops buying US debt, it could push other nations to also reduce the reliance on the US dollar, further diminishing its global dominance. This could lead to a situation where the US loses some of its economic leverage on the world stage. And number 5, global financial markets could experience volatility. Finally, let's talk about the global impact. The US bond market is huge. It's considered one of the safest places to invest in the world. US Treasury bonds are seen as a global safe haven because they're backed by the full faith and credit of the US government. Countries all over the world, from Japan to Brazil, hold US debt. If China stops buying US debt, the effects could ripple through global financial markets. Investors might start to question the stability of US bonds, and this could cause market volatility. If the value of US bonds declines, it could trigger a global sell-off, with investors pulling their money out of US assets and looking for safer investments elsewhere. We've already seen signs of this happening in the past when global financial markets are nervous. For example, during the 2008 financial crisis, investors fled to the safety of US bonds. But if China pulls back from buying, the flow of money might start shifting away from the US bond market. This could destabilize global financial markets and lead to greater uncertainty in the world economy. So, what happens if China stops buying US debt? In short, it could cause a weaker US dollar, higher interest rates, and budget challenges for the US government. China might also start focusing more on strengthening the yuan and looking for alternative investments. Meanwhile, the global financial system could experience more volatility, affecting everyone from Wall Street to Main Street. The impact would be felt not just in the US, but around the world. The US economy could face slowdowns, and countries that rely on US debt could see their financial markets take a hit. So, what do you think? Do you believe China could really pull the plug on US debt? And if they do, what do you think the long-term consequences will be? So, what do you think? Do you agree with our video? Tell us what you think by leaving your comments below. And if you like what you watched, make sure to hit the like button and don't forget to subscribe to our channel to show your support.